The S&P 500 has had a historic run between 2023 and 2025, with the index returning 86%, while its equal-weighted counterpart returned just 43%. But most of the gains came from a handful of stocks. Just 7 companies accounted for nearly half of last year's total return. And this did create the largest outperformance of the market cap-weighted index versus equal weight in any 3-year period since 1971. And so far this year, we're looking at energy, materials, consumer staples, and industrials leading the S&P 500 in terms of year-to-date gains. Well, joining me as we kick off the final trading week of January is Larry Tentarelli, Chief Technical Strategist of the Blue Chip Daily Trend Report. Larry, good morning. Thank you so much for joining us. So let's start out by looking at breadth versus index risk. So tell us what specific breadth or relative strength signals you're looking at in terms of a gauge for healthy rotation versus a setup for index level downside here.
Good morning, Remy. The biggest thing that I see is year to date, 61% of the stocks in the S&P 500 are outperforming the S&P 500 index itself. The equal weight ETF is also outperforming the S&P and triple Q. So what we're seeing is a bullish rotation into the other 493, as we like to call it. So industrials, materials, agriculture stocks are leading. And I think part of the reason is I think the market is expecting an extended Fed rate cutting cycle. In that scenario, you often see outperformance from cyclical stocks versus mega cap tech.
Yeah, Larry, I'm glad you mentioned that. Of course, this week we get the first Federal Reserve meeting of 2026, but no changes expected. But we will be watching Powell very carefully and monitoring his language to see if there's any change in terms of his statement. But when we're talking about what we're seeing in terms of sectors as well as small caps, historically, how reliable is the combo of what we're seeing as a forward indicator of economic strength, and what technical failure would invalidate the 2026 growth signals?
So the markets are considered a forward discounting mechanism. The markets generally tend to price in 3 to 6 months forward. So when you see these cyclical sectors breaking out, energy's broken out of a multi-year range. ExxonMobil's making new all-time highs. Small caps are making new all-time highs. A lot of the industrials have broken out. So the key thing that I would look to see here is we've got to watch incoming economic data. We want to watch payrolls data. But as long as these trends hold over their 100-day moving average, so the energy sector, the industrial sector, the small caps, as long as they hold over their 100-day moving average, then the intermediate term uptrend is confirmed.
Yeah, and while we're looking at charts, you're a technical analyst, so I know that you're looking at data behind the market action. So do you think mega cap growth stocks consolidating before another leg higher, or are you structurally watching what's happening in terms of leadership? And what types of chart behavior would confirm one scenario over the other? Break this down for us.
So I'm watching what's happening with earnings this week. So you really have a split market there. You've got stocks like Alphabet that have broken out to new all-time highs, super strong uptrend over all their moving averages. But then you've got stocks like Microsoft and Meta, which broke down completely below their 200-day moving averages. So you really have a split market as far as these Mag 7 stocks goes. Earnings are going to be very important. Obviously, the market reaction. A stock like Microsoft is really one that we want to pay attention to. The software sector overall has drastically underperformed versus semiconductors. It's underperformed versus triple Q. You've got stocks like Oracle that broke down completely below the 200-day moving average. So the real key thing that I want to see this week is how does the market react to Microsoft's earnings, and can Microsoft get back over the 200-day moving average? But it's definitely a chart-specific scenario in the Mag 7. They're not all going in the same direction. You really have quite a wide spread between these charts. But I think Microsoft this week is the key to get a gauge of what the market is expecting for AI software stocks.
And finally, Larry, before I let you go, what are the key downside levels or sector breakdowns that would flip your bullish view? And which groups would you expect to fail first if this is a false breakout environment?
We do need to pay attention to these tech stocks this week. So Apple has been very weak going into earnings. As I said, Microsoft's been very weak going into earnings. So the key thing that we want to see here is no major breakdown in Apple, no further breakdown in Microsoft. Those are the two key mega caps that we want to pay attention to this week. And I really want to watch that 200-day moving average for these big tech stocks. So I've got some Mag 7 exposure. We've got Alphabet, we've got Nvidia, we've got Tesla. But I will say in the technology area, semiconductor stocks have been much stronger. These hard drive stocks have been much stronger. And the Mag 7, I think it's a wait and see. And I'd like to see no breakdown in Apple and no further breakdown in Microsoft this week.
Well, Larry, thank you so much for your time this morning. Of course, we will be getting those earnings reports out later this week, so we'll see how the market reacts. Thank you so much for joining us.
Thank you, Remy.